Did you know that the global debt is now approaching $300 trillion? And this astronomical sum doesn't only concern large nations like the United States, it encompasses billions of small debts across the globe. To understand this situation, we first need to look at what it really means. A collective debt carried by governments, businesses, banks, and even individuals worldwide. The United States, the world's largest economy, accounts for $31.5 trillion of federal debt alone. In addition, there are $3.2 trillion of state debts, $17.1 trillion of household debts, and nearly $24 trillion held by corporations. However, these numbers represent only a small fraction of global debt, which also includes private debts, bank loans, and borrowings used to finance consumer goods like homes, cars, and even products such as video game consoles. The impressive figures of global debt. To put it all into perspective, the current global debt represents nearly 3 times the global gross domestic product, GDP. This means that every individual on Earth, on average, carries a debt of around $40,000, which may seem alarming, especially when considering that the average income per capita is much lower, around $10,000. Economists are divided on the issue. Some claim there is no reason to worry, while others fear that this situation could jeopardize the global economy. What does global debt really mean? Global debt isn't as simple as an individual or even a country's debt. In fact, global debt functions somewhat like a giant loan, where the borrowed money isn't just owed to another country or company, but often to the future itself. This system is unique, complex, and hard to understand because there is no global entity managing all this money. Economists sometimes joke that they haven't yet found a way to get Martians to approve this loan. On an individual level, debt seems simple. Someone borrows money from another person and agrees to repay it over a set period. But on a global scale, there is no single lender, which means that every debt also represents an asset for someone else. In other words, if a nation or business borrows money, it also creates value for other economic players. This leads to a crucial question. Is this debt really a problem, or is it a tool for creating future wealth? Debt, an investment tool? Let's take a moment to imagine that the global debt of $300 trillion is a single global loan. This loan must be repaid with money generated by investments that create value in the future. This means that accumulating debt can have advantages if it is used to fund infrastructure projects, innovative technologies, or education programs that generate long-term value. The problem arises when this debt is used to finance immediate consumption without creating future value, which could have disastrous long-term consequences. The risks of excessive global debt. So can we live with global debt that is 3 times the world's GDP? The answer is not simple. On one hand, debt helps stimulate the economy, especially by financing projects and allowing consumers to spend and businesses to invest. But on the flip side, too much debt eventually creates pressure on repayments, forcing governments and businesses to cut spending, which can lead to periods of recession. At a global level, when nations go into debt, it initially leads to an increase in economic production because more money circulates, stimulating consumption and investments. However, at some point, debt repayments start to weigh heavily on public and private finances, slowing down spending and investment. Understanding global debt, the GDP measure. A key concept to understand global debt is the debt to GDP ratio, a measure often used by economists to gauge economic health. Although this global debt to total GDP ratio may seem alarming, it doesn't capture the full complexity of the situation. For example, if an individual has debt equal to 3 times their income, this might not be a problem if it's a student loan or mortgage that will allow them to invest in assets that will increase in value. On a global scale, what matters is understanding that debt is also linked to global assets, which are estimated at more than $1 quadrillion. This means that despite the heaviness of debt, global assets still far exceed these debts, helping to maintain some economic stability. The dynamics of the global economy. Debt cycle and economic conditions. In a globalized world, the global economy follows a natural debt cycle, where periods of high debt are followed by periods of repayment, causing fluctuations in economic growth. Governments play a key role in this cycle by adopting an economic policy called counter-cyclical policy. During recessions, governments increase spending to stimulate the economy, while in times of prosperity, they should reduce spending and increase taxes to avoid excessive debt accumulation. However, many governments have failed to implement this policy in a balanced way. Instead of reducing deficits during periods of prosperity, they have continued accumulating debt, leading to a situation where public and private debts have become uncontrollable in some countries. How to exit the global debt crisis? In the face of this situation, the simplest solution for governments is to invest in sectors that increase productivity, such as infrastructure and education, to ensure that future revenues will far exceed debt repayments. If governments invest in projects that generate wealth over the long term, this debt can be repaid without compromising global economic stability. Conclusion: is global debt a tool or a threat? In summary, global debt is neither entirely good nor entirely bad. It all depends on how it's managed. If it is used to finance value-generating investments, it can contribute to economic growth. But if it's poorly managed and used to finance non-productive spending, it can lead to global economic crises. The challenge is to maintain a balance and ensure that debt is used to build a better and more prosperous future for all.